Are we teetering on the edge of a financial precipice unseen since the Roaring '20s or the dot-com bubble? History might not repeat itself, but it often rhymes, and the echoes of past market peaks are reverberating through Wall Street today. Scene script. Take a moment to consider the stock market's current state. It's buoyed by a wave of enthusiasm, particularly around technology and AI, reminiscent of the exuberance that preluded historic downturns. The Roaring '20s, the swinging '60s, the late '90s, all periods marked by a surge in investor optimism followed by significant corrections. These historical patterns suggest we might be near another peak, fueled by what some see as a tech-driven euphoria. Bill Smead of Smead Capital Management articulates this sentiment sharply. He draws parallels between today's market dynamics and those of yesteryears, predicting not one, but three bear markets over the next 10 to 15 years. These, he believes, will serve as a necessary antidote to the current speculative excesses. But what's driving this fervor? Look no further than the AI and tech sectors. While the transformative potential of these technologies is undeniable, their current valuations remind seasoned observers of the bubbles formed around radio, television, and the internet in their nascent stages. Smead warns of an impending correction, suggesting that while the technology is revolutionary, the financial frenzy around it might not be sustainable. Yet, amidst these warnings, Smead finds a silver lining in energy stocks, particularly oil and gas. He argues that the increasing demands of AI and data centers will continue to drive the need for robust energy solutions, even as the world shifts towards renewable sources. This sector, somewhat paradoxically, stands to benefit from the tech boom, making it a compelling choice for investors looking for opportunities outside the tech bubble. However, caution is advised in other areas such as banking. Banks heavily exposed to commercial real estate are navigating turbulent waters, with the rise of remote work leading to a surplus of office space and potentially significant losses. In this complex landscape, Smead champions the timeless strategy of value investing. He sees a future where, once the dust settles from the speculative fervor, solid, fundamentally sound companies will rise to prominence once more. In essence, while the near-term outlook might seem bearish due to current market excesses, the long-term perspective holds promise, particularly for those who invest wisely in sectors poised to underpin the next technological revolution. As the market cycles ebb and flow, those who learn from history rather than being doomed to repeat it may find themselves well-placed to capitalize on the opportunities that emerge from the upheavals.